Good evening, friends, and all the members of our fraternity. It's truly heartening to welcome all of you for this Sky High Symposium number 56. And I think that's a series of Sky High Symposium which we've been organizing for last, I think, more than a year. And I think we have excellent success response speakers, which I think have responded so well. And even the participants has really encouraged us to continue this Sky High Symposium. And I think this is one great opportunity for each one of us to learn from these experts. We have the eminent speakers today. We have Madam C.A. Jhalak Parekh. She'll be taking us through the amendments in capital gains applicable for assessment year 23-24. And then we have Madam Anupama Sharma. She'll be covering the wealth management. So I think, and of course, very important coordinators we have Chetna, I can see Sheetal, and then we have Ruchi, Paramveer, and Pranali. Thank you so much for being here. And all the participants, I will once again welcome. And I think just to add with all the participants that this is one series of events which we are organizing. And of course, this committee being the Women and Young Members Excellence Committee, we've been organizing a symposium for young members also, which we have started, and almost 11 we have completed, and we would be having the 12th one very soon, which is on Friday, and we organize them regularly, and we encourage young members who are, of course, members less than the age of 35, which as per the council approved age, and we expect that members, participants, young members who want to come forward, speak on different topics, technical topics, non-technical topics, or any other topic of interest of members. More importantly, I would say professional opportunities, which each one of us look for, and especially those young members who come into practice. So it's a good opportunity that we listen to these experts. And of course, like we have today, Jhalak and Anupama, both will be covering those important topics. Participants would really be benefited with their experience, expertise in their respective field. And I'm sure this webinar, again, would be a successful webinar for each participants. And of course, the role of coordinators has always been excellent. And they've been doing a great job for Women and Young Members Excellence Committee. So thank you once again, each one of us, for being here, for the office from Office Ruchi, of course, ensuring that this webinars continue. And Shanu and all team of Women and Young Members Committee, they're doing excellent job. And I again wish this webinar a happy learning for each participants and everybody who's listening to this deliberation of experts. Thank you very much. So Ruchi, I think over to Chetna would start. Yes, Chetna, over to you.
Thank you, Abhay sir, and thank you entire team for giving this opportunity and this going on series which gives us lots of updates and everything. So today I would like to introduce Ms. C.A. Jhalak Mehul Parekh ma'am. She has done her BCom, FCA, DISA, CISA, and FAFD. Currently, she is partner of Jintalwala and Company, and mainly handling the project finance work and company law matters and CIT appeals. As a professional achievement, she is a third rank holder in the Ahmedabad and 8th in Gujarat in board exam of 12th standard, and all India 50th rank in PCC examination, and she just stood third rank in the DISA examination as well. She has cleared her forensic audit and fraud dictation examination. She has also wrote article on the digital footprints in CA Association Ahmedabad Journal. That's a great achievement, ma'am. And as her hobby, she loves to read, dance, singing, and she participated in All India Radio as anchor and also completed her Bharatnatyam. And she has performed Bharatnatyam in National Dance Festival and obtained degree of Madhyama Purna in classical music. Amazing, ma'am. So over to you, Jhalak ma'am. Just throw light on the topic. Very interesting topic, I can say, amendments in capital gains recently, which are applicable for financial assessment year 2023-24. Over to you, ma'am.
Good evening, everyone. Thank you, Chetna ma'am, for introducing me. Thank you, Abhay sir, for giving a welcome address. I thank Women and Young Members Excellence Committee for inviting me to give some highlight on the today's topic, that is a capital gain amendments applicable for assessment year 23-24. So first, let me share my screen. Is it visible now? My screen is visible? Yes.
Ma'am.
Yeah. So our today's lecture is on amendments in capital gain applicable for assessment year 23-24. Before going for amendments, let's first see what are the existing provisions and existing tax brackets are under the capital gain. We have broadly two types of classification under capital gain, that is long-term and short-term capital gain. Under long-term capital gain, also there are three types of different capital gains that are taxable. First is LTCG on securities, units or zero coupon bonds on which STT is paid. Currently, it is exempt up to rupees 1 lakh, and above 1 lakh, 10% tax rate is applicable. LTCG on securities, units or ZCB on which STT is not paid, it is taxable at either 10% without indexation or 20% with indexation, whichever is beneficial to the taxpayer. LTCG to non-resident or foreign company, unlisted security shares and debentures, that is taxable at 10% without indexation. And all the other long-term capital gains, like on other movable, immovable properties, is taxable at a flat rate of 20%. Short-term capital gain, that is bifurcated in two parts. That one is on which STT is paid on securities, units or zero coupon bonds. It is taxable at a flat rate of 15%, and all the other short-term capital gains are taxable at a slab rate. Of course, surcharge and health and education cess is over and above this tax rate. So let's see what are the amendments that are applicable from assessment year 23-24. Firstly, there is a cap surcharge on LTCG has been capped from this assessment year to 15%. Secondly, there is an introduction of virtual digital asset from assessment year 23-24. Another amendment is with regards to 194 IA to bring it in a parity with section 50C. There are certain exemptions that are introduced with regards to IFSC. There is one small amendment with regards to taxability of goodwill as a capital gain. And there are definition changes in provisions relating to bonus stripping and dividend stripping. Let's see in a brief what are the amendments. First is with regards to cap on surcharge on LTCG. Before assessment at 23-24, on all the taxable income, if net total income is above rupees 1 lakh and it is less than 1 crore, surcharge applicable was 10%. If net total income exceeds 1 crore and it is below 2 crore, surcharge applicable would be 15%. If it is greater than 2 crore and less than 5 crore, SC surcharge would be 25%. And if it is exceeding rupees 5 crore, maximum surcharge that is applicable is 37%. From assessment year 23-24, it has budget 22 amended section and said that surcharge on LTCG arising from transfer of any type of asset has been capped at 15%. So if long-term capital gain is more than 50 lakh but less than 1 crore, the surcharge would be 10%. And if it is more than 1 crore, it is surcharge would be applicable on long-term capital gain would be 15%, subject to marginal relief. Next is a concept of VDA, that is virtual digital asset, that is introduced in by Finance Act 22. Let's see what is virtual digital asset first. New clause to section 2 has been introduced, that is 47A, which defines virtual digital asset. Virtual digital asset means any information or code or number or token not being Indian currency or any foreign currency, not being Indian or foreign currency, generated through cryptographic means or otherwise by whatever name called, providing a digital representation of value which is exchanged with or without consideration, with the promise or representation of having an inherent value, or functions as a store of value or a unit of account and includes its use in any financial transaction or investment, but not limited to investment schemes, and can be transferred, stored, or traded electronically. Non-fungible token or any other token of similar nature as defined by central government are included in this definition. Income from transfer of this kind of virtual digital asset is taxable under section 115BBH at a flat rate of 30%. So let's see now how this VDA are taxable under which head and at what rate. Sale of VDA may be treated as income from business profession or may be treated as income from capital gain, depending on the how taxpayer has shown it in its books of account. If taxpayer is showing it as its stock in trade in its books of accounts, then VDA would be taxable as a business and profession income. If the taxpayer is showing it as investment, then it will be taxable as a capital gain. And in that also, if VDA is held for more than 36 months, it will be treated as a long-term capital gain. And if it is it is held for less than 36 months, it will be treated as a short-term capital gain. In any case, whether it is shown in a business profession head or capital gain, long-term or short-term capital gain, the flat rate of 30%, flat tax rate of 30% is applicable on VDA transactions. However, surcharge may differ in case if it is pursuing this latest amendment in surcharge cap in long-term capital gain. Surcharge may differ if it is shown as a long-term capital gain or a short-term capital gain or business profession income. Now, important points to note here is that set-off of loss incurred under any other head of income is not allowed from income from transfer of VDA. So any loss cannot be set off against this income. Second thing is, in any expenditure incurred other than cost of acquisition shall not be allowed as a deduction while computing income from transfer of VDA. So any cost of further improvement or any other expenses incurred for acquisition are not allowed as a deduction from income from transfer of VDA. Third thing is, loss arising from trading of VDA shall not be allowed to be carried forward for set off in the next year. So whatever, if it is a loss from VDA, then we must forget it. We cannot carry forward for the next year for setting off. There are certain say controversies surrounding this taxability provisions of VDA, and government might introduce some guidance with regards to that. Like definition of VDA is very wide. So it is wide enough to cover e-way bills, credit card points, etc. as well in its definition. Second thing is, when VDA transactions are settled, then how to give a valuation to those transactions, because VDA are also liable for withholding tax. So withholding tax is with regards to sale consideration, and if they are already settled, then how to consider that how to make TDS from the sale transaction or purchase transaction is a query. Though it has been taxable under Income Tax Act under Section 115 BBH, the legality of crypto transaction is still questioned. because RBI has once already asked for banning this crypto currency, but Supreme Court has denied it. But still, it is not illegal or it is not even completely legal, but still it is taxable under income tax. Another thing is that definition, as we have seen, of VDA specifically excludes foreign currency from its ambit. So if so the main provision or main motive behind introducing this section is to get Bitcoin and similar cryptocurrency transaction under its tax radar. But in last September 21, El Salvador country of Central America, adopted Bitcoin as a legal tender in its country. Also recently in March 23, Central African Republic, CAR, also amended its law and allowed Bitcoin as its legal tender. And thus it is making Bitcoin as a foreign currency and making it out of definition of Section 247A. So we need to see how it can be taxable and how the change in definition of VDA government will make to make it taxable under the Section 115 BBH. Next amendment is with regards to 194 IA. We know that Section 50C or 43 CA or 50 CA has already been amended. Before amendment of 194 IA, TDS was required to be deducted on sale consideration value of immovable property where total sale consideration exceeds rupees 50 lakh. But whereas the taxability provisions of the same, that is 43 CA and 50 CA, says that income is chargeable to tax as higher of actual sales consideration or fair market value or stamp duty value. But the same concept of FMV or stamp duty value is not introduced in Section 194 IA. So now to remove inconsistency, Section 194 IA has also been amended. And in case of transfer of an immovable property other than agricultural land, TDS to be deducted at the rate of 1% of such sum paid or credited to the resident or the stamp duty value, whichever is higher. So now from assessment year 23-24 onwards, TDS on purchase of immovable property under Section 194 IA will be deducted at 1% of higher of actual sales consideration or FMP or stamp duty value, whichever is higher. Next amendment is with regards to IFSC. Certain exemptions are introduced relating to GIFT IFSC, that is International Financial Services Center. So any transfer of offshore derivative instrument or over-the-counter derivatives entered into with the offshore banking unit set up in an IFSC is exempt from capital gain. In addition to income arising from transfer of an aircraft was already exempt from capital gain, but from AY 23-24, income arising from transfer of ship is also been exempted. So with ship which was leased by a unit of an IFSC to any person shall be eligible for deduction under ATLA while computing income of OBU in an IFSC unit, subject to certain conditions. Provided that that unit must have commenced its operations on or before 31st March 24. The same date is again been extended to 31st March 25 from by budget 23. Relocation of funds from overseas jurisdiction into GIFT IFSC has been exempted if it is relocated before 31st March 23. It is exempt. Any relocation of fund is exempted from capital gain. Also now from budget 23, this date of 31st March 23 has been extended by sunset provisions by another 2 years. And so any relocation of fund to GIFT IFSC would be exempt till 31st March 25. So this will provide additional time to asset managers who have just been licensed to operate in GIFT IFSC or are in the process not to only look at the greenfield funds, but also migrating existing offshore funds into GIFT IFSC. The next amendment is with regards to capital gain on goodwill being a part of block of asset. So previously goodwill was a depreciable asset, but since amendment in Finance Act 21, goodwill has been specifically removed from the block of intangible asset and thus making it non-depreciable asset. So Finance Act 21 introduced proviso to clause 2 for removing goodwill from the block of asset, but the similar provision for taxability of goodwill was not introduced. So Finance Bill 22 introduced amendment in section 50 relating to special provision for computation of capital gain in case of a depreciable asset. Accordingly, any reduction of goodwill of a business profession from the block of intangible asset shall be deemed to be a transfer and will be taxed as a short-term capital gain. This amendment is applicable retrospectively from 1st April 20, and accordingly it applies to all assessment year from assessment year 21-22 and subsequent assessment years. Let's see how how calculation of this short-term capital gain is done. For example, on 1st April 2020, there is a block of intangible asset as of rupees 80,000. There is addition during the year of rupees 25,000. There is deduction with regards to sale during the year is rupees 75,000. So making our net block before deduction of goodwill as 80,000 plus 25,000 minus 75,000. That is rupees 30,000. Now actual cost of goodwill after deducting depreciation till 31st March 20 is rupees 50,000. Now our block is of only rupees 30,000 and our cost of goodwill is rupees 50,000. If we'll deduct rupees 50,000 out of 30, it will make excess of rupees 20,000, and that excess is taxable as a short-term capital gain. But let's see if there is only goodwill is the only asset in the block of asset. So there will be no impact and it will not be taxable. If goodwill is the only asset in the block, it will not be taxable. So another amendment is with regards to bonus stripping and dividend stripping. These provisions are there since many years, and let's see what these provisions are. Bonus stripping, people generally used to do this like before introduction of bonus or dividend by a company. They will buy shares of a company and they will sell shares after introduction of bonus or dividend at a reduced market price, and thus making it making some short-term capital loss. In case of dividend, they will enjoy benefit of exempt dividend, and also reduce after reduction of market price, they will sell it, and there will be short-term capital loss. They will set it off against other short-term capital gains. In case of bonus, the same thing happens. They will buy shares before introduction of bonus and they will sell it after price reduces, and they will sell the bonus share having a zero cost at a higher rate after 3 years, and they will enjoy the benefit of exempt long-term capital gain. So to restrict these practices, there are provisions of section 94(7) and 94(8) for of bonus stripping and dividend stripping. Previously, these provisions were applicable to mutual fund units only. Now, Budget 22 has amended the definition of section 94(7) and 94(8). In 94(7), they have introduced word units as a business trust units, and they've also included infrastructure investment trust, InvIT, real estate investment trust, that is REIT, and alternate investment fund, AIF, also in this definition. So now onwards, all the dividend stripping relating to this InvIT, REIT, or AIF that are newly introduced funds are also covered in this dividend stripping provisions. In existing section 94(8), that is for bonus stripping, transactions of mutual funds were exempt, were covered. But from budget 22, this definition has also been amended to include securities and units in its ambit. So securities includes all equity shares and securities, and units again includes all the business, newly introduced business trust, that is InvIT, REIT, and AIF in its section. So now onwards, what if before introduction of dividend or bonus, if someone as taxpayer has purchased shares before 3 months and is selling after the record date of 3 months, any loss arising out of this transaction will be not allowed to be set off against any other taxable income. So that is it for all that covers all the amendments of for assessment in 23-24. So Ruchi ma'am, can we take any questions with regards to this topic?
Yes, definitely. So there is one question from an member. So if any advance is received for the sale of land, so should that be invested in REC bonds within 6 months of receipt, or the investment needs to be done with 6 months of sale date?
From the sale date, investment must be done within 6 months from the sale date. Is it?
Yes.
Yeah.
So, okay. So I would like to thank Jalak Parik ma'am for this wonderful session that you have conducted. You have aptly covered all the amendments and very nicely just made us go through all the amendments, may it be virtual digital assets or the TDS or the goodwill, the bonus stripping, the dividend stripping, and everything. And you have explained all of this very wonderfully. So thank you so much. And I would like to even thank ICI for giving us this opportunity to come and even be a coordinator for this. So thank you so much, ma'am. And if anyone has any other questions, can just put up like. Yeah, so I think we've done, there was only one question.
Okay. Thank you so much.
So I hand it over to the next person, Pranali ji. You can just take it further.
Yes. Shall I start with it? Anupama ma'am is there. Hello, am I audible?
Yes, you are audible.
Okay, okay. Anupama ma'am has joined now. Ruchi ma'am?
No, Anupama ma'am, I am not able to see her.
So we need to inform her first.
Yes.
Ruchi ma'am, Yes, fine.
Anupama ma'am to join in. The session was really wonderful. And she really gave a nice insight on all the amendments. Anupama ma'am is joining in another 5 minutes. Now we just received a message. Washroom break if anybody wants to. And in 5 minutes, ma'am will be joining.
Okay.
Pranali ma'am, you have not introduced Anupma ma'am, not till now. She's joining in a minute or two, so then you please start with her introduction.
Yeah, sure.
Yeah.
Request all of you all to please stay in the meeting. Anupama ma'am is shortly joining. Thank you. Meanwhile, if anybody has any questions, so please put it forward. Jalak ma'am, are you there?
Hello. Yes, I'm there.
So there's one more question. Meantime, I think till ma'am comes, we can take up.
Yeah.
So can we take up the question?
Yes,
you
yes,
okay with
yeah,
it?
yeah.
Yeah.
Let's take.
Okay. So somebody has mentioned there is also an amendment with debt-oriented mutual fund. So is there so like?
Uh, Yes, there is amendment with regards to data-oriented mutual fund. That is, it will be considered as a long-term capital gain, and but that is applicable from assessment year 24-25. It is introduced in budget 23. So this year, this amendment is not applicable.
Okay, thank you so much, ma'am. Pranali ji, you can start from here.
Okay, so am I audible to everyone?
Yes, absolutely.
Okay. Now I'm starting with the next session. A very good afternoon to the respected speaker for our first session, CA Jalak Parikh. The speaker for the session, CA Anupama Sharma, seniors in the profession, and my dear friends. A very warm welcome to all of you. Now moving to our next session, that is wealth management. Wealth management, as we all know, it's a need of an hour. It offers an opportunity for career advancement with the potential to move into leadership or executive roles. So having said that, I find myself privileged and honored to introduce the next speaker, C. Anupama Sharma. C. Anupama Sharma, our very own fraternity member, a chartered accountant with All India rank in both intermediate and finals, alumnus of the University of Madras, Chennai, a qualified chartered accountant with 22 years of diversified experience in wealth management, with a wide range of expertise in wealth advising division and executive director at 361 Wealth, earlier known as IIFL Wealth. She plays a key role in the firm's growth strategy of further expanding wealth operations, especially in the western branches of Mumbai, Pune, Gujarat, and Indore. Prior to joining 361 Wealth, her previous stints includes her association of more than 10 years with Kotak Mahindra Bank as an executive director and a regional business manager, and 11 years with Citibank. Ma'am, we welcome you. Having introduced such a powerful, diversified, and a high-profile speaker, CA Anupama Sharma, I'm sure we will be having an enriched webinar. Thank you so much, ma'am. I request you to please take the session ahead. Thank you.
Thanks, Pranali, for the introduction, and it's a pleasure to be here with all of you. I also thank the Women and Young Members Excellence Committee for having me here with all of you here. And thanks to the Institute of Chartered Accountants of India, and thanks to Preeti Savla, who's the chairperson. Have spoken to her briefly, but not met her as yet. So look forward to catching up with her as well. But it's a pleasure to be here with all of you, and it's even a greater pleasure to cover what I do, which is my core passion, which is wealth management. So like Pranali mentioned, I've been in the wealth management industry now for over 22 years. So chartered accountant by qualification, but been in the banking space which is the banking and the financial space now for over 22 years. So what I'm essentially going to cover today is wealth management, the various asset classes, how we approach portfolios when we kind of advise families, and the approach that we think works best across market cycles to essentially give long-term sustainable returns. So to make our session a bit structured, I've actually put a presentation together, which I'll put up, and we could just run through that, today. Give me a minute. I'm just going to display it here. Okay. Is my screen visible, Pranali?
Yes, ma'am.
Okay, great. So what I'm essentially going to cover is, wealth preservation and optimization. So when we talk about wealth management as a subject, it's about optimization of returns. We always look at preservation. We are always advise investors, the families that we manage, to basically look at preservation of capital first, and then comes in growth. Because wealth creation is not something that one tries to achieve in portfolio management. What you try to achieve here is preserving the wealth that you've created and optimizing the returns. So that's a basic premise of wealth management. So essentially, when one is looking at wealth preservation, what's also important is that you protect against inflation. Right. So what that means is that when you're looking at wealth preservation, when you're looking at an asset allocation approach, very, very important to ensure that you protect your capital against inflation. So how do you do that? I mean, one can achieve that by, looking at diverse asset classes when you build your portfolio. So, equity as an asset class, when one typically believes that, it is, it's volatile, it's not stable. But if you look at past data, what it essentially shows is that equity has a potential to beat inflation in the long run. And how, some data points here on this slide, which kind of show that. If you look at rolling returns of equity in the last, since inception, this is in various tenor buckets. So for example, last 15 years, 12 years, 10 years, 7 years, 5 years, so on and so forth. What you essentially see in this table here, which is on the left-hand side of the screen, the rolling returns on equity as an asset class across tenor buckets, ranging from 1 year to 15 years, have been in the range of 14 to 15%. And your maximum and minimum range on equity. Of course, the shorter tenor rolling returns, will be volatile because equity is a, volatile asset class. But if you're a long-term investor in equity, you typically average anywhere between 12 to 14%. And that's what, this data point on the left-hand side of the screen shows you. The percentage number of times equity is actually given you returns more than 12% in a longer time frame of 15 years is 82%. So what it essentially shows you that if you kind of are looking at building a portfolio where you want to preserve your capital, and also see growth from there on, it is important to follow an asset allocation approach. So when we talk about principal protection, it doesn't mean that all of your money gets into fixed income or gets into debt. Because if you do that, then you're not really protecting your capital against, the inflation. So very important to follow an asset allocation approach. And the truth is that equity as an asset class, while volatile, but at the same time, if you kind of stay in for longer periods of time, like this data shows us, it does give you long-term compounded returns. On the other hand, on the right-hand side, we also have some income-generating assets. REIT, for example, which is a real asset, is also a great inflation hedge. A REIT is nothing but a real estate investment trust. And the way this asset works is essentially gives you, dividend income, which is essentially the rentals which get generated out of the underlying assets. Plus, it gives you an appreciation in the asset. So essentially, a great asset to have in the portfolio, which gives you a 6 to 6.5% rental yield, because these are all commercial real estates. Plus, typically the REITs are, today we have about 4 listed REITs, on the stock exchange, right? And all of these real estate REITs, real estate investment trust, typically hold high quality, commercial real estate as the underlying. So what you get out of these or out of this asset class is your rental yield, which comes in as dividend. And dividend for REITs as an asset class is also tax-free. So one benefits from a tax angle as well. Plus, since these are high quality assets, all grade A properties, one also kind of sees capital appreciation over a period of time. So equity REITs, are asset classes which help you protect against inflation. Of course, that doesn't mean that, out of $100, all your monies get into these kind of asset classes, but important to follow an asset allocation approach where you define what is your safety pot. The safety pot then becomes the fixed income part of the portfolio, which could be a combination of bonds, fixed deposits. It could be, REITs, InvITs, real assets. And then on the other side, you have the growth capital, which is equity. But always remember, equity as an asset class, has to be, a longer investment horizon. So essentially, this slide again talks about equity, which talks about how equity as an asset class behaves over longer periods of time. So what we've essentially done on this chart, again, on the left-hand side, it actually shows how equity as an asset class is volatile in the short term, but very, very attractive in the long term. So what we've tried to do here is show you returns, which is the average returns on equity, the maximum minimum return, and the volatility on equity asset as an asset class. So the line graph here shows you that longer the holding period, right? We start from 5 years to 30 years. So longer the holding period, you see the line graph slope downwards. So what that means is that the volatility as you increase the holding period on equity comes down, right? And your returns also, which is your minimum returns on equity as an asset class, kind of go up as you increase the holding period. So for shorter holding periods, one can make negative returns on equity. But as you increase the holding period on equity, the probability of making negative returns on equity as an asset class becomes zero. And hence, equity, and there are different ways of investing in equity. One doesn't really need to get into direct equity stocks. It depends on the profile of the client and the investor behavior. One can look at equity mutual funds, one can look at alternate investment funds, and we've listed down the various ways in which one can invest in equity on the right-hand side. But essentially, equity as an asset class needs to find a position in your portfolio when you look at wealth management, because that's the bucket which will help you, kind of outperform inflation, right? Or beat inflation. So various ways of investing in equity is one looks at investing in equity either through equity mutual funds, which are, publicly listed equities, more diversified, open-ended, have high liquidity. And because they are diversified, from a risk profile point of view, they are medium to high risk because ultimately it's equity, so subject to market volatility, but they have the return potential. Then is your unlisted and the private equity market, which I'll cover separately. I don't want to confuse here, but that's, that's again, one of the product classes within equity as an asset class that one can look at. And then you have your portfolio management services, which is PMSs, which is our customized portfolio of securities, listed equities, which are more closely managed and more concentrated and managed by fund managers. So these are the different ways that one can invest in equity. But essentially what I'm trying to bring here in this slide is that if you are a long-term investor and have a holding horizon of 10 years plus, I mean, we always say 5 years plus, but typically, if you want to kind of ensure that you get, your long-term equity returns and, with least volatility, then, be a long-term investor. And this table here or the graph here on the right, on the left-hand side clearly shows you that the minimum returns in equity go up as you increase your holding horizon. Okay, and another interesting point is, timing equity market is tough, right? We all, when we talk of allocations in the market, we say that we don't want to time the market. But do we really do that? Answer is no. We always wait for the market lows to get into the market, whether it's through mutual funds or direct equity stocks. I think as investors, even as individual investors, we want to kind of try and see if we get the market lows. But I think what data shows us is the reverse. It really says timing the market is tough and missing the mark comes with its consequences. So what we've tried to show here on the left-hand side of the slide is that, if you try sit on the sidelines trying to time the market, you actually sometimes miss the peak of or you miss your returns, right? So by missing the 10 best days in the cycle or in the last, we've taken data here for the last 18 years, which is between 2005 and 2023. And what we are essentially trying to show here is that if you keep sitting on the sidelines, on the side, you can actually see your portfolio value erode by more than 50%. And that's what we are showing here in this table. So essentially, don't wait on the sidelines to time the market. If you are an investor who does not want to keep a close tab on what's happening in the market, the best way to invest in the market is through systematic investment plan, which is the middle graph, right? If you're an investor doing systematic investments and investing periodically at pre-decided frequencies, you kind of can average at a return as high as 15%. And this data is for a period, it's written in finer print here, but essentially it's for a period between 2009 and 2022. And so essentially what this shows is that if I'm an investor who's been investing through SIP in equities, then through mutual funds, then I'm averaging at a return of 15.2% CAGR. However, if I give the same money to a portfolio manager where the manager follows, its tactical calls and selection of products, then in equity, then one can get a 4% high alpha on the portfolio. So your 15.2 then becomes 19.1. On the other hand, if you're an investor who's just kind of put point-to-point returns in the same underlying, then it's 13.8. So net equity as an asset class over longer periods of time does help you beat inflation. 13.8 to 19%, definitely beating inflation, definitely beating your risk-free returns, which in today's scenario are about 7.25. But at the same time, you can try and increase the alpha by being a little smart about the way you approach the portfolio and manage the monies. What I've also tried to do here is include returns on hybrid funds, which are essentially balanced funds, which have a mix of debt and equity. And that actually shows you a range of 7.4 to 12.5%, which again is higher than your risk-free return. So for a balanced kind of investor who does not want to look at an exposure of 100% equity, one can always adopt this route, which is the hybrid route. And then comes your fixed income category, which is your safety pot, right? Now, the safety pot, which is your fixed income, which is done through various fixed income strategies. Now, debt funds are not going to be as popular as what they were up till March end because of the changes in the taxation or amendment in the finance bill. But essentially, this space can give you a return, even in today's scenario where interest rates are, it gives you anywhere between 7 to 7.25. So essentially, net, the message that I want to give you through this slide is that timing the markets is very tough. So don't wait sitting on the sidelines. If you don't have an advisor advising you, follow the systematic route. If you have an advisor working with you, so let them, and if you trust the advisor, of course, then let them take the calls, on when to enter and what the underlying should be. It should always yield you better results, like you see in the out here. And even if you do point to point and just, invest and forget it for the next 10, 15 years, it still gives you higher return than your risk-free debt. That's what, I'm trying to convey here through this slide. Okay, this is very, very interesting in the context of where we stand today. So the way we, essentially today from a fixed income point of view, we are at an interest rate cycle where the yields have pretty much peaked and we are seeing the rates cool off, right? So what past data actually shows us that, and this is in time periods between 2004 and 2008 and 2010 and 2014, where the repo was at its peak, which is 9 and 8%. What we've actually seen is that post peak rate cycle, you've actually seen markets also perform, right? So today we are at a time zone where we essentially see interest rates having peaked from 7.5 10-year GSEC in the month of March. Today we are at 7% 10-year GSEC, and we believe that the interest rates will slope downwards. However, from a equity return point of view, past data shows that post the peak rate cycle, that is where we are today, equity markets give you a return of anywhere between 10 to 12%. Again, better than and more tax efficient than than your risk-free return on fixed income, right? So all these data points I should show you how your equity as an asset class behaves and how it's important to ensure that you preserve capital and make a return which is higher than the inflation, because only when you make a return higher than the inflation, you're actually preserving capital. Otherwise, your real growth is negative. See, this is again repetitive because time frame, like I said, it really matters in equity. So the first, the graph on the left-hand side, the bar chart rather, on the left-hand side, shows you that longer the time frame, the longer you're invested. So this is 5, 7, and 10 years. The longer you're invested in equities, lower the odds of getting negative returns. So essentially, if you're a 10-year investor, then the probability of making negative returns is 0%. If you're a 7-year investor, it's again 0. If you're a 5-year investor, then the number of instances where returns would be negative, these are of course rolling returns, is 0.1%, right? So the longer you are invested in equity as an asset class, lower the odds of getting negative returns. And longer the time frame, you get better returns, right? So if you're a longer term investor, which is a 10-year and a 7-year investor, the probability of getting a return greater than 7%. And the reason I've taken 7, because that's where your 10-year GSEC is at today. So if you're a 7-year or a 10-year investor in equities, then the probability of making more than 7% is as high as 98 to 99%. 5 years, it's 85%, right? So which is also not bad. So essentially, what we need to know is that, if you stay invested in equities as an asset class for longer periods of time, the probability of making higher returns, which is a 7 and a 10% year, is as high as 98, 99, and 82%. All right. So essentially, time frame in equity does matter. You need to be patient and need to be a long-term investor. Then comes my safety pot, which is essentially the debt bucket, which we call fixed income, right? So, I made a point in the previous slides where I mentioned that, equity as an asset class. Sorry, you'll have to just give me half a second, just 1 sec. Sorry, I'm in a seminar. Give me like 10 minutes, 15 minutes. Okay, so essentially, when we look at fixed income, you can't ignore fixed income because debt is also very, very important to have in the portfolio. But what happens is if you look at 100% fixed income portfolio, you're actually eroding capital. Why is that? Because, today, for example, let's take where we stand today, right? Your risk-free return on debt, which is your GSEC or a high-quality corporate bond, gives you about 7%. And, if you kind of take inflation, it's at 6.5, or real inflation even higher. So what you end up actually making is negative returns. So what we're trying to show you here is that, if you kind of are an investor only in fixed income, then you would either be negative or in the range of anywhere between 1 to 2% in terms of returns. So yes, debt is important because that's your safety pot. That's the pot which gives you peace of mind and gives you consistency in the portfolio at any point of time. But at the same time, having the right asset allocation mix between equity and debt is also important so that, you make returns which are higher than what the inflation is. And you kind of average at a return which meets your investment objective. So how do you invest in debt? Of course, like I said, the one vehicle which was very popular till March end is your debt mutual funds. Now with the taxation, changes in taxation become less popular because you don't really have a tax benefit. Bonds remain a good opportunity, which are nothing but a fixed income securities, which are issued either by the government or by corporates, and give you either accumulated returns or give you interest income. But what is important when you choose a bond is the credit risk associated with the issuer of the bond. So understanding who the issuer is, which is the corporate, what is the credit rating, what is the balance sheet like, because you, of course, have to go beyond the credit rating as well. And basis that, you kind of try and pick up the bond portfolio. Why will I do a bond vis-a-vis a fixed deposit? Because, sometimes if the bond is attractively priced, for the same corporate versus a fixed deposit, then, obviously I would look at a bond, while today the tax treatment for both the instruments is the same. Okay, this is, an asset class which was skipped in my slide on equity in the previous slides. So this is essentially my private unlisted space, private market. So when I look at equity as an asset class, you essentially have listed equity on one side and you have the private unlisted private markets, which is the unlisted market on the other side. So when we look at unlisted market, and of course, this doesn't suit all profiles, you need to have the risk appetite, you need to have the investment horizon. And the reason why one does the unlisted or participates in the unlisted market is, of course, to get a higher return. So while listed equities over longer periods of time gives us anywhere between 12 to 13%, this space, which is the unlisted space, is always meant to deliver, 3, 4, 5% more than what my listed equity gives. So if your listed equity is giving you 12, 13, 14%, this bucket essentially, because your investment horizon is longer, is meant to give you anywhere between 18 to 19%. Now, how does one achieve this as an investor? You can participate either through, funds. Today, you have fund managers in the industry who understand the space well. and have SEBI approved funds in the early, mid, and late stage, via which investors can actually invest. And you also have direct opportunities that come to some sophisticated investors from time to time, and they participate in these companies. But important to note that this is a space which is really growing in India. The market's currently as high as 1 trillion. Okay, and the enterprise value which will get created by the Indian startup space. When I say startup, is basically I'm trying to cover all the, the unlisted space here. Between 2021 and 2025, could actually grow at a multiple of 3.2x. So that shows, the growth, or the speed of growth, in this space, which is in the unlisted space. And so clearly a space that cannot be ignored, has great growth potential. And depending on your risk appetite, depending on your holding horizon, one could look at taking an exposure in the portfolio. But always remember, these are longer term opportunities, where one needs to be invested for, 5, 6, maybe even longer, in terms of number of years. And hence, you need to have the holding horizon capacity, and you need to have the risk appetite. So essentially, this is your alternate bucket. We categorize this as the alternate bucket when we look at portfolio construction. Then within debt, which is my safety pot, is also the alternate structured credit space, which we also call performing credit. Now, essentially, the way we look at this as a landscape, is structured credit is that credit where banks typically have constraints to lend to. And hence, the corporates would look at, NBFCs, or would look at, asset management companies to lend money to them. Sometimes banks are risk averse, NBFCs have liquidity issues, and then you have corporates who have kind of growth plans, and have high liquidity and on a growth trajectory, coming to asset management companies to kind of get structured credit. So these are, from an investor point of view, these become high yielding opportunities where they can park some amount of their fixed income portfolio. The reason I say some amount, because obviously you need to have a cap in your overall allocation when you look at structured credit. So this is a space which is actually, now becoming deeper and deeper, and, finding a place in the fixed income bucket of investors, because like I said, with the tax changes, and I'm going to talk about the tax changes, but I think it's already covered in the previous session. But with the tax changes in the, in the amendment to the finance bill in the month of March, debt mutual funds have become less attractive. So what is important for a investor when he looks at fixed income is to essentially look at the post-tax return, right? And hence, if you have to look at post-tax returns in your hands, you need to look for, opportunities like maybe REIT, InvIT, structured credit, which, from a post-tax basis get you closer to anywhere between 7 to 9%. So a structured credit would kind of get you somewhere in the range of 8.5 to 9% post-tax, post-expenses, etc. REIT, InvIT will get you maybe anywhere between 8.5%. So the thought here is to look at assets, or look at your fixed income opportunities where you don't dilute credit quality at all, but essentially you look at returns where your post-tax returns remain intact. So this is the structured credit space, which is now becoming, far deeper and finding a place in portfolios of investors. So just to summarize, and the summary is across asset classes, which is essentially, equity and fixed income. What I've tried to do here is kind of give you what are the pre-tax returns across each of these asset classes, which is equity, fixed income, and sovereign gold bonds, and given you what are the expected returns. Like today, when one talks about equity mutual funds, like I said, 12 to 14% is what you expect. Now, within equity, one way of investing is through diversified mutual funds, but the simplest way of investing, keeping risk at its minimum, is through index funds, where one can target anywhere between 11 to 12%. You can also participate in the international markets through feeder mutual funds, where one looks at a return of anywhere between 10 to 12%. And then you have managed accounts, which are essentially PMSs, portfolio management services, where one expects a slightly higher return than what you get in the diversified mutual fund space, because these are more closely managed, and hence going with an estimate of 15%. While actually reality the last 3 years has been pretty different with these portfolio management services. So this is not something that is our all-time favorite, but we do look at some of these categories because they sometimes generate an alpha over this bucket, which is your mutual fund and the ETF bucket. Then comes your fixed income space, where one looks at returns, like I said, anywhere between 7 to 13%. These are all on gross basis pre-tax. Okay, and the reason it's 13% here because it's structured credit, but your short-term mutual funds, your accrual mutual funds, your direct bonds will give you anywhere between 7 to 8. REIT, of course, along with the capital appreciation, gives you 9.5. The current yield on REIT, which I'm talking about, the rental yield, which comes via dividend, is about 6.5%, and 9.5 includes the capital appreciation on the underlying asset. So that's how is the expectation of returns across the various product classes within these asset classes. Okay, I spoke about this a bit in my previous slide. When we talk about wealth optimization, it's important to arrive at the right asset allocation. And what is the approach that you follow when you do your asset allocation? When I say asset allocation, it's obviously asset allocation across your broad asset classes, which is equity and fixed income, which is debt. But what is the approach and how do you arrive at that asset allocation for a first-time investor? One approach that a lot of families kind of adopt, or a lot of investors adopt, is your safety pot approach, which is the first approach, where you kind of define your safety pot, which is the fixed income part of the portfolio, which will give you peace of mind. And that becomes your safety pot. And then the rest of the monies can get into growth capital, which is equity. The other approach that a lot of investors like to follow is defining a return expectation. And then you work backwards to arrive at the asset allocation. So if you're an investor who says that, okay, I'm going to be happy with a 9% post-tax returns, then how much do you invest in debt and how much do you invest in equity? Because today one knows that equity as an asset class, and I've showed you the various data points, can give you anywhere between 12 to 14%. And one knows fixed income basis where your 10-year GSEC is, what will that asset class yield you? So today, for example, fixed income, I'm talking risk-free return. Of course, one can look at some amount of structuring and try to increase the yield there. But if you look at plain vanilla risk-free debt return, that's at about 7%. So if you look at a combination of both, if equity is going to give you 12, 14 and debt is going to give me 7, and if I have if I have an investment objective of achieving 9, then what should my ideal mix be so that I get to 9? Should it be 50-50? Should it be 60-40? So that's it's the return expectation approach. And then is the risk profiling approach, which is just the traditional way of doing asset allocation. In the risk profiling approach, you actually go through a detailed questionnaire where you determine what's your risk tolerance, what your risk appetite is, and then kind of ascertain what should be in fixed income and what should be in equity. And of course, the last way that we've kind of mentioned here is your goal-based asset allocation. So you list down your goals that you have to achieve. It could be a goal relating to kids' education, marriage, etc. And basis that, then you kind of pick up the asset allocation basis, your investment horizon to reach those goals, right? So this is as per the individual goals, and hence would obviously be very, very customized to each person or each family. So these are the different ways that one can adopt to decide what your asset allocation should be. But essentially, the basic premise of managing money or managing wealth is first determining what the asset allocation is. And if you get that mix right, according to your investment objective, then trust me, your job in terms of getting your returns is pretty much met. So that's our first rule when we look at wealth optimization. Okay, this is again a very, very interesting slide which talks about performance and volatility of various asset classes. So what we've essentially tried to show here is how, what I've kind of highlighted here is a 10-year and 20-year return, on various asset classes, which is US equities, Indian equities, gold, and REIT, right? And here there's Indian equities, US equities, as well as the, US Treasury and the India Corporate Bond Index. So what this actually shows us is that if we are investors for 10 years and 20 years in equities, and the first is essentially talking about the US equities here, you essentially make 10 to 8% over 10-year and 20 years. Similarly, Nifty as an index, which is our India equities, is giving you 12 to 16 years in 10 to 20 years. But what we observe in equity as an asset class, the drawdowns also have been maximum. What are drawdowns? These are essentially the lows of the market. So markets or equities as an asset class, US equities has corrected to the tune of 57% in March 09. And similarly, in October 08, Indian equities have corrected to the tune of 60%. Similarly, when I look at the bond index, of course, US treasuries have been 1 to 4%. But if I look at the Indian corporate bond index, it's been in the range of 7%. But look at your drawdowns here, have been as low as 2.5%. Even for US treasuries, as low as 11%. So equity as an asset class, yes, volatile, subject to high drawdowns. But if you ride the volatility, then the returns also pay off. That's the message that we want to give here. So this is the message here, right? You should not hope to benefit from equity compounding unless you can stomach the volatility. So if you can stomach this volatility, if you kind of go through these drawdown cycles, like what we saw in 2008 and 2009, then, and if you continue to stay invested, you still make your 10 to 14% kind of returns in equity as an asset class. And your bond index, again, it's obviously the stable part of the portfolio, sees lesser drawdowns, and your return objective is only about 6 to 7%. And then comes your REIT and gold as an asset class, where gold is supposed to be a hedge, when markets are uncertain. But you've seen it behave pretty differently in different periods of time. So, gold typically, our investors, any which ways, hold Indian families like to have gold any which ways as an asset class. Do we really look at gold as a serious asset allocation? Maybe not at all times, but yes, 5% allocation to ride through volatile times and uncertain times, I think brings in some amount of mental peace. But from a return perspective, one looks at a range of anywhere between 8 to 10% as far as gold as an asset class over longer periods of time is concerned. So clearly, coming to the second rule of wealth optimization, we believe that diversification is very, very important. What this chart shows you is that it's a 5-year annualized return as on these dates, right? As on March 23, what is in the last 5 years, which are the asset classes which have performed the best? So your best performing asset class, which is recent in the last 5 years ending March 23, has been gold. Then comes equity, which is Nifty 50. Then is your mid-cap index, and so on and so forth. But as I move to different time periods, and as I go, in the previous years, you see every asset class having behaved differently, right? So even within equity, the mid-cap index has yielded better returns in some time periods versus the large cap index. So essentially, what we need to do is ensure that we have a well-diversified portfolio, so that lower returns in one asset class doesn't really hurt you. And within the asset class, even the product class, right, or the market cap index. So you need to ensure that you follow diversification to have long-term, sustainable, stable returns. Then comes your long-term planning. I think I've spoken about this enough, how long-term planning or long-term compounding helps you yield better returns. This clearly shows how rupees 100 invested in 1980 grows over a period of time in 2023. So very, very important to stay, if you're an equity investor, stay invested over longer terms. And clearly for long-term investors, the number of negative observations are minuscule. And, I've shown that even in the previous chart. and it helps to ensure that you get your risk reward benefit. Okay. Another important point when you look at wealth optimization is also to look at tax efficiency and cost efficiency. So looking at investing, keeping taxes in mind, keeping, cost in mind, very, very important. So when it comes to taxation, equities as an asset class, of course, long-term capital gain, you need to be invested at least for 1 year in order to get long-term capital gain. This helps reduce your tax burden because short-term capital gains, your taxation is at 15% on equities. So consider the timing of selling the investment to optimize the holding period and minimize the tax impact, right? So when you're selling your investment, booking profits, always keep in mind your holding horizon, because that's important, because ultimately, whatever gain you realize, you're going to pay taxes, right? But if it can be long-term capital gains, on equity, you need to be a 1 year investor in order to get long-term capital gains. Now, again, you have certain exemptions which are available, and there's section 54F, 54, 54EC, which help you to set off some of the capital gains that you realize. Now, 54F is for sale of business, right? Sale of unlisted shares, etc., where you can set off by buying a property, while the amount is capped now to 10 crores. But essentially, these are some of the options that are available. So when you are looking at managing your money, I'm not going to get into detailing of these sections, but the idea is to keep your tax planning in mind. Okay, and another important point which we kind of advise investors, or we look at when we look at our own monies as well, is tax loss harvesting. So sometimes, you can offset capital gains by strategically selling investments that have experienced losses. And these losses can be used to set off the capital gains and reduce your overall taxable income. So one can look at that as well, which is essentially looking at tax loss harvesting. And then comes in your dividend tax optimization. Now, dividend, is taxable in the hands of the investor, right? So when we look at equity as an asset class, if you're looking at listed equity, please keep in mind that the dividends with the stocks are going to pay you are going to be taxable at the rate of 35%. While if you're investing through a mutual fund vehicle, they are exempt, right? And if you're getting into a growth option, even better, because there is no dividend tax leakage. In a PMS, in a direct equity portfolio, the dividends that come from the underlying are tax-free. So keep these factors in mind when you're managing your monies, because ultimately, when you look at returns, it has to be post-tax returns. So if you have a direct equity portfolio, or you have monies given to a portfolio manager through a PMS, make sure that that portfolio is giving you that return, maybe a 1-2% return extra to make up for the dividend tax leakage. Also keep in mind your cost of investing. I kind of discussed with you in the previous slides the various ways to participate investing in equity and debt. So in equity, for example, one can invest through index funds, you can do mutual funds, you can do portfolio management services, you can do alternate investment funds, which are called AIFs. Now, each of these product classes have a cost associated, the cheapest being the index funds, right? But you don't want to kind of get into index funds only because they're cheap, right? From a management fee point of view. You also want to ensure that you don't compromise on return. So consider the cost of investment vehicles and then weigh the pros and cons. If you kind of get to invest in these category of investments without compromising on returns, then obviously that's what one must do as an investor. So figure the cost, figure the management fee, figure the returns, the carry sometimes as a profit share sometimes in each of these investments, and figure all of that too before you look at investing monies into this, because ultimately higher the cost, it erodes into your returns. So this slide is basically, like I said, when you have to invest, you have to look at tax and you have to look at cost efficiencies. So this table actually gives you the tax rate across various categories of investment, which is, so if you are an investor in equities, your long-term capital gain, your short-term capital gain, dividend on equity shares, I mentioned, is 35%. So very important to know this, because what happens is the moment you get into a direct equity or a PMS portfolio, the dividends from the underlying are taxable in your hands. So to that extent, it erodes your return. Important to note, it always goes unnoticed. Unlisted equity, we spoke about the private markets, are taxed at about 23% with indexation, which means you can index your cost for your every year of investment. Then you have but of course, if you hold unlisted equity for short term, which is less than 2 years, then it's 39%. But that's not going to happen in case of unlisted equity, because unlisted equity is always meant to be a longer term investment. Then MLD is effective this year, again, at maximum marginal rate, which is 39%. Debt mutual funds effective this year, again, at 39%. FD is similar to debt mutual funds, which is again at 39%. And then comes your bond category, which is, at 39%. Your long term is still at 24%, but that means staying invested for 3 years. Your gold ETFs, etc., are at maximum marginal rate, which are at 39%. Okay, this has nothing to do with managing monies, but very, very important for preservation, which is looking at estate planning. So looking at estate planning, looking at different vehicles which help you do succession planning or estate planning is important. One typically looks at basics is to have a will in place. You seek professional advice for doing this. A lot of families also look at the trust route. Trust route helps them to not only achieve succession planning, estate planning, but also ring fencing of assets through trust. So essentially, a lot of families look at various ways and means to achieve estate planning, but very, very important to be, considered when you look at overall, wealth management and estate management. Okay, that's pretty much. I mean, I've tried to keep it as simple and straightforward. Any questions? Happy to take. Can't hear you. I think you're on mute, Paramveer.
Okay, thank you so much, Anupama ma'am. Can you hear me?
Yes, I can. I hope I didn't go fast. I think I have a tendency to go a little fast, but any questions, happy to take.
So ma'am, we do not have any queries as of now,
Okay.
but this shows that, you have explained it very nicely.
Okay, thank you. I hope so.
Yeah, so thank you very much, ma'am. It was indeed a very knowledge enhancing session by you. And I feel incredibly privileged and honored to have allowed to extend a vote of thanks of this webinar. I, CA Paramveer Kaur, on behalf of Women and Young Members Excellence Committee, would like to propose a vote of thanks to our speaker, CA Anupama Sharma, for devoting her valuable time and sharing the insights of the topic. I also want to thank CA Preeti Savla, Chairperson, Women and Young Members Excellence Committee, CA Abhay Chajer, Vice Chairman, Women and Young Members Excellence Committee, for organizing such webinars for uplifting our women and young members. I would also like to grab the opportunity to thank our participants for their active participation. I would also like to thank our technical team for their continuous support and coordination during this webinar. Also, thanks to my co-moderators of this webinar. Thank you, everybody. And by saying this, I request the technical team to please conclude this webinar.